I'll describe convertibles in a basic way. It can be as complicated as possible, but I think it's better to be very simple. Warren Buffett says he doesn't do a deal unless he can figure it out on the back of an envelope. So what is a convertible? A convertible is a bond that gives the holder the right to convert into the underlying stock. A typical arrangement would be when the bond is issued at $1,000 par, it might be convertible into stock worth $800, say convertible into 40 shares with the stock trading at $20 a share. So the idea is, if that stock goes up, let's say this is a 5-year bond, what if the stock doubles from $20 to $40? Then your 40 shares are worth $1,600, so that when the bond matures in 5 years, you don't take the $1,000 at redemption. Instead, you convert into stock worth $1,600, and you've made a profit of 60% in a capital gain. And also, let's say there's a 4% coupon, so in 5 years, you will have collected 20% in interest. So add that on, and you've got a total return of 80% when the stock went up 100%. If we assume the underlying stock doesn't pay a dividend, and that's often true of the sort of growth companies that issue convertibles, then you've captured 80% of the upside. I mean, almost the whole upside from the convertible. Yet, on the downside, if the stock doesn't perform, let's say that the original value of those 40 shares at $20, $800, it's the same 5 years later, well, as long as the company avoids default, you've collected 20% simple return in 5 years, while the shareholders have earned nothing, or worse, they may have suffered losses. So you have this asymmetry in convertibles that over time means that the total return is actually equivalent to that of equities, but the volatility is lower and the downside risk is much lower than outright ownership of equities. The key reason to take a closer look at convertibles is that they work over time. I mean, what more could you want than equity-like returns? I mean, if you look at charts over decades, fixed income securities go up a little bit over time, the total return does, and equities they're the top of the chart over time, and convertibles go with them. Moreover, the idea that convertibles give you lower volatility and, perhaps more important conceptually, less downside risk, this is very favorable psychologically. Markets inevitably break. There are bear markets, there are market crashes, and when this happens, there will be all kinds of bad headlines that nothing the government or the Fed is doing is working anymore. France has just defaulted. I mean, who knows what's coming? The president's policies aren't working. North Korea is about to attack Guam. Who knows? But when this happens, people are going to be scared. And those who are down 20% with their stocks are going to be more scared than those who are down only 10% with their convertibles. They will have a stronger ability to at least ride out the storm and ride the inevitable upturns. They also may even have the ability to swap into securities that will give them an even higher total return on the rebound. We've tracked rising interest rate periods going back to 1993 and 94. There have been 10 periods in which 10-year Treasury rates went up for 1 or 2 years, and in each time, in 8 of those 10 times, convertibles have had a superior return in that time frame. I mean, they haven't gone down. Generally, in a period like that, the economy is strengthening, equities are strengthening, and that uplifts the convertibles. Tech is the continuity in convertibles. At Advent, we've traced convertibles back to 1830s, and there was this hot new technology. In fact, it was literally a hot technology because it was driven by fire, burning wood to make steam to run a steam railway, chug, chug, chug. That was the great new technology of the 1830s. The steam railways in the US and in Britain floated convertibles to finance their expansion. It's a perfect parallel to the multiple convertible bonds that we've seen from high-tech companies, that Apple, Google have issued convertibles, and more recently, right now, Tesla, the new electric cars. Tesla needs all kinds of capital to exploit this new and growing market, and convertible securities are a way that Tesla can get lower interest rates than if they floated straight bonds, and it's also a way that they can sell stock now, in essence at a higher price in the future. So that this is an excellent way for Tesla to raise capital, and it's a superb way for investors to participate in a company like Tesla that has a wildly volatile stock. I mean, it might go down. If it does, we're going to get our money back in 5 years and earn some interest on our Tesla bonds. If the stock goes up, we're going to participate in most of that upside. The key advantage of the closed-end fund structure is that, unlike open-end funds, we don't get redemptions and we don't get new share purchases coming in. And open-end funds are constantly whipsawed. When they're in a hot market that is maybe overvalued, when they probably shouldn't be investing aggressively, more money is flowing in. When the market is doing poorly and opportunities are abounding, money is taken out at the bottom. I have managed open-end funds in the distant past, and it just drives the portfolio manager crazy. I couldn't do what I want to do. We get hit with liquidations. I've got to sell something into a plunging market. There's another factor too with closed ends, that without these flows, closed-end funds can invest in less liquid securities, which are often more attractive. In the convertible world, it enables us to buy smaller convertible issuers. Also, in the 3 convertible funds that we run under the Guggenheim label, we are able to invest in things like high-yield securities to boost our yield. These are not always liquid securities. We do not have to worry about having to sell at the end of the day. Well, just in general, the fact that closed-end funds sell at discounts is extremely favorable. You don't have to be Warren Buffett to figure out that a closed-end fund is undervalued. Our discounts have lately been coming in, have been declining. This could be a trend that will continue to give a little fillip to our return. And what I like to do is I carry this dollar bill in my pocket in case someone asks that question, that you know, if you can get the fund at a 5% discount, in essence, you're buying a dollar bill for 95 cents. And this is a pretty good deal, and it's a reason to be in closed-end funds.